Welcome to this explainer. Look, today we're taking a hard, unfiltered look at the realities of trading the world's most famous digital asset. If you're approaching the crypto markets with the expectation of easy money, well, I actually need you to pause and listen very carefully. As an advisor deeply invested in protecting your capital, I'm here to lay out an expert's blueprint. We're going to completely strip away the hype, focus entirely on the core mechanics, and approach this with a cold, calculated discipline that is absolutely required to survive. So why do most beginners lose? Because here's the undeniable truth. Bitcoin has created millionaires, yes, but it has also utterly destroyed countless unprepared trading accounts. Why? Because the vast majority of beginners just enter this arena completely blind. They try to navigate this massive market without understanding order flow, they severely misuse cross-margin leverage, and honestly, they just end up becoming exit liquidity for institutional algorithms. They treat a complex, high-beta asset like a lottery ticket, and we are not going to do that.
Okay, let's dive into this. Here is our roadmap. 1. The reality of Bitcoin trading. 2. Core mechanics and leverage. 3. A simple beginner strategy. 4. Mastering risk management. 5. Market forces and platforms. And finally, 6. Final rules for success.
Let's start with Section 1, the reality of Bitcoin trading. Digital gold versus high risk. Now, you already know what Bitcoin is, but as a trader, you must view it completely differently. Bitcoin is an unhalting 24/7 market. There are zero circuit breakers here. This constant liquidity and extreme historical beta are exactly what create massive asymmetrical profit opportunities. But, and this is crucial, that exact same environment will ruthlessly expose any flaw in your strategy. It demands absolute, calculated respect. Moving on to Section 2, core mechanics and leverage, the totals of the trade. Now, what's really interesting about this comparison is the hidden risk. In spot trading, you actually own the underlying asset. If the price dips, you only suffer unrealized losses. There's literally no liquidation price. Futures trading, however, wow, it's a totally different beast. You're trading derivatives, which allows you to short the market and access leverage. But my practical tip here, futures carry hidden costs. You absolutely must monitor funding rates. If you're long while the market is overwhelmingly bullish, you are going to pay a premium every 8 hours just to hold that position. Listen to me on this one. Leverage is the ultimate account killer. Using 10x leverage turns $100 into $1,000 of buying power. Sounds great, right? But here is the trap. Exchanges have auto liquidation engines. If your $1,000 position drops just a few percentage points, the exchange will forcefully close your trade to protect their collateral. You don't just lose a little, your entire initial margin is wiped out instantly. If you lack consistency, your leverage must remain at zero, period. All right, Section 3, a simple beginner strategy, the blueprint. So how do we fix the gambling mindset? Here's a mechanical blueprint to replace emotion with pure execution. Step 1, identify the macro trend. We use the 1-hour or 4-hour charts because, frankly, lower timeframes are just filled with algorithmic noise and fake outs. Step 2, mark support and resistance. Look for areas of high historical trading volume, not just random price wicks. Step 3, wait for a candlestick to actually close to confirm your thesis. Amateurs enter on the fear of missing out. Professionals enter on confirmation. And step 4, a hard stop loss on every single trade. This is non-negotiable. Which brings us to the most critical part. Section 4, mastering risk management, the shield. The golden rule of institutional survival, and I mean the absolute golden rule, is risking no more than 1 to 2% of your account per trade. Why? It's simple drawdown math. If you risk wildly and lose 50% of your account, you don't need a 50% gain to recover. You literally need a 100% gain just to get back to zero. Limiting risk mathematically guarantees you can survive a streak of bad trades without severe damage to your portfolio. And this brilliantly illustrates the concept. By keeping 98% of your capital completely untouched, you create an unbreakable shield around your portfolio. You are deploying only a tiny expendable scouting party into the market. This ensures that one chaotic wick, or maybe one emotional error on a Tuesday morning, is just a mere flesh wound rather than a fatal blow to your trading career. Okay, zooming out a bit to Section 5, Market Forces and Platforms, the macro view. Bitcoin doesn't operate in a vacuum, guys. It's highly sensitive to macro liquidity. First, watch the DXY. That's the US dollar index. An aggressively rising dollar actively drains capital away from risk assets like Bitcoin. Second, monitor the NASDAQ. Bitcoin currently trades a lot like a high beta tech stock proxy. Finally, global interest rates. When rates fall, fiat liquidity floods the system, driving crypto higher. Ignore these macro forces, and honestly, you're trading blind. Now, your choice of battlefield matters. Binance, Coinbase, Kraken, Bybit, and OKX offer the deep order book liquidity you absolutely need to enter and exit without massive slippage. But remember, holding funds on an exchange introduces counterparty risk. So here's my advice to protect your vault. Utilize IP whitelisting. Set up strict withdrawal address approvals, and always separate your active trading capital from your cold storage holding capital. Finally, Section 6, Final Rules for Success, the Council. Let's talk about you and your capital. These behavioral pitfalls will bankrupt you faster than a market crash. Revenge trading, trying to instantly win back a loss, is financial suicide. Chasing massive green candles, that means you're already too late and you're basically buying the institutional sell-off. The professional trick to combat this? Keep a strict trading journal. Documenting your entries, exits, and your emotional state is exactly what separates the gamblers from the tacticians. So the crucial point is this core philosophy. Your objective is not overnight wealth. Your objective is consistent, measurable profitability. You do this by ruthlessly protecting your capital, trading with iron discipline, and letting compound interest do the heavy lifting over months and years. I want to leave you with this question to chew on. Reflect honestly on your recent trades. Are you actually executing a tested strategy? Or are you just pressing buttons based on hope and fear? What is your biggest operational weakness right now? Identify it, fix it, and start trading like a professional. Thank you so much for joining me for this explainer. Keep your risk tight and your discipline unbreakable.